Imagine, just for a moment, two completely different realities happening at the exact same time.
Okay.
In one reality, it's called the global reality. The financial floor is just shaking. You've got trade wars firing off between major powers. You have these algorithms causing flash crashes in the stock market.
Sense of chaos.
A huge sense of chaos. And this feeling that the rules the last 20, maybe 30 years are just sort of crumbling.
It's a world that the survey really defines by, I think, 2 words. Fragmentation and fragility. It's a very chaotic picture.
Right. But then you step into this second reality, the Indian reality in 2026. And here, well, the banks are cleaner than they've been in decades.
Healthier than anyone expected.
Borrowing money is actually becoming cheaper. The whole machinery of finance seems surprisingly calm. I mean, robust even.
And that right there is the central tension of Chapter 3. It's this incredible juxtaposition. How is India managing to keep its financial ship not just steady, but actually accelerating, while the global ocean is, arguably choppier than it has been since 2008?
That is exactly what we're going to figure out today. We are looking at the mechanics of this resilience. We're not just reading the headlines. We're trying to look under the hood.
And the engine room this year is absolutely fascinating.
It really is. But before we get our hands dirty with all the data, I want to properly welcome you to another deep dive here at Simplified UPSC by PPP.
Yeah?
We are so thrilled to have you with us for this breakdown.
It's great to be here. This is one of those chapters that I think really separates the serious aspirants from the casual readers.
Yeah.
The details here are just critical.
It really does. Now, just a little bit of housekeeping for our community, because we really want to make sure you have every single tool you need to crack this exam.
Right.
If you're getting value from these deep dives, if we're helping you connect the dots on these, pretty complex economic concepts, I'm just humbly asking you, please subscribe to the channel.
It makes a huge difference.
It does. And if you're capable, if your situation allows for it, please consider joining our paid membership on YouTube.
It really does support us directly. It ensures we can keep the lights on, keep the research team digging deep, and, keep bringing you this super useful content.
Absolutely. And a massive, massive shout out to all our existing members. You guys are the absolute backbone of this project. Please do hit that like button and share your thoughts, your questions in the comments. We actually read them, and they really do shape how we approach these topics.
We really do. And for the resources, because we know you need the hard copies, the notes to revise from, we've made free notes available on our Telegram channel.
And these aren't just notes.
No. For the series students, they include practice past year questions or PYQs linked directly to today's topic. You read a section, you can immediately test yourself.
And for our legend members on YouTube, you know who you are, head over to the exclusive Discord channel. Yeah. Right now, you've got the premium notes, extra PYQs, and this is crucial, those model mains answers waiting for you.
Do not miss out on those. They're designed specifically to give you that edge, that structure in the exam hall.
Okay, housekeeping clear.
Let's get to work.
Let's talk mission. We are taking on a beast today. We're analyzing Chapter 3 of the Economic Survey 2025-26. The title is Monetary Management and Financial Intermediation, Refining the Regulatory Touch.
And I want to invoke our no-skip rule right from the start. We are going to be moving through pages 79 to 140 of the survey.
The whole thing.
The whole thing. We are not summarizing. We are analyzing every single nook and cranny.
So why the obsession with detail on this one?
Because this is the money chapter. This is the plumbing of the economy. If you don't understand how the RBI manages liquidity or why the banks are shifting their lending strategies, you just can't understand the macro economy.
Right.
And more importantly for our listeners, you can't write a nuanced, high-scoring answer in GS Paper 3. The devil is truly in the details here.
So we're talking about the RBI, the banks, the stock market, even your pension. Let's start where the survey starts. The global context, Section 1.
The backdrop. And it's a stormy one.
Reading through the introduction, specifically Section 3.2, the survey uses some very, very heavy language. It talks about a vastly interconnected global financial architecture that is now facing fragmentation.
Fragmentation.
Now, fragmentation is a word we hear a lot in, say, international relations. But what does it mean in a financial context in 2026? What is actually fragmenting?
It means the flow of money is hitting walls. It's getting stuck. For the last 30 years, the ideal was that capital, money, flowed seamlessly across borders to where it was needed most.
The global village of finance.
Exactly. But in 2025, we hit what the survey calls the tariff shock.
This is the big U.S. policy shift, wasn't it?
Yeah, it was. In early 2025, the U.S. imposed significant new tariffs, much larger than expected. Now, usually we think of tariffs as a trade issue. We think about, the price of imported cars or steel going up.
Right, it's a real economy thing.
But the survey points out the financial ripple effect, which is instantaneous. When the U.S. raises tariffs, it creates immediate and massive uncertainty. The survey actually references the Trade Policy Uncertainty Index. It didn't just rise, it spiked. It went vertical.
And when that index spikes, what happens inside the mind of a global investor sitting in, say, London or New York?
Panic, but a very specific kind of panic. It's what we call a risk-off event. It's like a switch flips in the market's brain.
Risk off, meaning get me out of anything that looks even slightly risky.
Precisely. Investors pull their money out of emerging markets, places like India, Brazil, South Africa, which are seen as risky, and they shove it into safe havens.
Which is why we saw gold prices just go crazy in the first half of 2025.
Exactly. Gold is the ultimate bunker in a storm. But it wasn't just gold. We saw global equity markets take a serious dip. And more importantly, risk premiums rose. The cost of doing business, of borrowing money globally, suddenly got more expensive because everyone was afraid of what would happen next.
The survey does mention that the markets normalized relatively quickly after some of the tariff announcements were clarified. So was it just a blip? Or is there something deeper here that we should be worried about?
And that is the trap. It's so easy to dismiss it as a blip. The acute phase passed, yes, but the scar tissue remains. The survey makes a very subtle but incredibly important point here. The baseline level of uncertainty is now structurally higher.
What does that mean, structurally higher?
It means investors are jumpy. They're on edge. They are waiting for the next tweet, the next policy announcement, the next shoe to drop. The trust in a predictable global system has been eroded. And that brings us to the second, and frankly more surprising, global risk the survey highlights.
You're talking about AI.
Artificial intelligence.
I have to admit, when I saw a dedicated section on AI in the monetary management chapter, I did a double take. I expect to see AI discussed in the science and tech chapter, or maybe in the employment chapter, talking about job losses. But why is the economic survey flagging AI as a financial stability risk?
It's a fascinating and I think very forward-looking addition. And it comes directly from the IMF's latest financial stability report, which the survey quotes. The core concept here is something they call herding behavior.
Herding, like sheep all running in the same direction.
In a way, yes. But imagine sheep running at the speed of light, all controlled by the same brain. Here's the problem. In the old days, you had thousands of human traders on Wall Street. Some were bullish, some were bearish, some were at the Wall Street Journal, others were at the Financial Times. You had a diversity of opinion, of thought processes, which actually stabilizes the market.
Right, so if I panic and sell, you might see it as a buying opportunity because you have a different analysis. My panic is your profit.
Exactly. But now imagine that all the major hedge funds, the big asset managers, are using sophisticated AI models to make their trading decisions.
Okay.
The issue is these models are often trained on the same public data sets. They use similar historical prices, similar news feeds from Reuters, similar macroeconomic parameters. So in essence, they all think alike. Their thought process becomes homogeneous.
I think I see where this is going. It's scary.
It is. If a shock hits the system, let's say an unexpected oil price spike or a political event, these AI models might all calculate the exact same risk adjustment at the exact same millisecond. They all conclude the risk has gone up by 7.3%, therefore sell.
And because there are no humans in the loop to second guess it, to say, hang on, let's wait a minute, the market just collapses instantly.
It amplifies the shock enormously. It removes the natural friction of human doubt and deliberation that usually slows down a crash. The survey uses a great word. It warns that this creates markets that are brittle.
Brittle? That's a good word. They look strong on the surface, but they can shatter instantly with one sharp knock.
It's like an echo chamber, but with trillions and trillions of dollars at stake.
And this risk is compounded by what the survey calls the valuation bubble in tech.
Yes. The data it presents on the S&P 500 is just staggering.
The dominance of tech stocks.
It's more than dominance. Since ChatGPT launched in late 2022, a handful of tech stocks, specifically the ones directly linked to the AI boom, have accounted for something like 75 to 90% of the S&P 500's entire growth.
That's an insane concentration of risk.
Yeah.
So the entire U.S. stock market rally is basically just hope, a bet on AI.
It's a massive multi-trillion-dollar bet that AI will revolutionize productivity immediately. Not in 10 years, but now. But the survey asks the really uncomfortable question, what if it doesn't? Or what if the productivity gains take a decade to materialize, not 2 years?
If those valuations correct,
Yeah.
if the market realizes the hype outran the reality.
If that bubble bursts, the shockwaves won't just stay in Silicon Valley. It will hit global finance. It will hit capital flows to India. It's a classic concentration risk, but on a scale we've never really seen before.
So we had trade wars creating uncertainty and AI creating brittle, overvalued markets. And then, just to add a little more spice to this chaotic mix, the survey brings up crypto, specifically stablecoins.
The quiet giant in the room.
The market cap for stablecoins, it says, crossed $305 billion. That's a roughly 50% increase in a single year. But again, for the UPSC aspirant listening, why do we care? Isn't crypto still on the fringe of the financial system?
Not at $305 billion it isn't. That is no longer fringe. That is becoming systemic. The key word you need to write down in your notes here is spillover risk.
Spillover, as in spilling from crypto into the real world.
Precisely. Stablecoins don't just exist in the cloud. To maintain their peg, their promise that one token is worth $1, the companies that issue them hold massive amounts of real financial assets.
Right. They have to back the coin with something real to prove it's worth $1.
Exactly. And what do they hold? U.S. Treasury bills, commercial paper from large corporations, and huge amounts of cash and regular bank deposits. So they are now deeply, deeply interconnected with the traditional banking system.
Okay, I see the risk now.
If a major stablecoin collapses, imagine a run on the bank, but for a crypto token, which has happened before. The issuer would have to fire sale those treasury bills to meet redemptions. They'd have to pull billions of dollars of cash out of the traditional banks.
Which could destabilize the regular banks and the bond market.
Exactly. It spills over. The problem in crypto land becomes a problem for your local bank. It's become too big to ignore. The survey is essentially saying regulators can't just treat this as a niche hobby anymore. It's a structural vulnerability in the global financial architecture.
It really paints a picture of a global system that's just walking on eggshells. And in that context, there's this fascinating box in the survey box 3.1 that talks about uncertainty in investment. I found this part really counterintuitive.
The panel SVAR study. Yes, it's a great piece of analysis.
Yeah. Putting the econometrics aside for a moment, the conclusion was about who gets hit hardest by all this uncertainty we've been talking about. I would have assumed it's the small guys, the tiny micro enterprises. They have the least cash, the smallest buffers, right?
That is the logical assumption, isn't it? But the data says something completely different. The study found that mid-sized firms are actually the most vulnerable when uncertainty shocks hit the economy.
Why the middle? That seems so odd.
It's what some economists call the muddled middle problem. Think about it this way. The massive conglomerates, the Tatas, the Reliances of the world, they have huge internal cash reserves. They operate in dozens of different sectors. If one sector is facing uncertainty, they can rely on another. They can weather any storm.
Okay, so the giants are safe. They're too big to fail, in a sense. What about the tiny guys, the small shops?
The micro enterprises are surprisingly agile. They have very low overheads. They can change their business model overnight. If the market shifts, they can pivot quickly. But now think about the mid-sized firms. They have high fixed costs. They have factories, big payrolls, but they don't have the massive financial buffers or the diversification of the giant.
They're too big to be nimble, but too small to be safe.
You've nailed it. They are too big to hide, but too small to fight. So when uncertainty hits, like that tariff shock we talked about, their capital formation, their investment in the future, it drops the fastest and the hardest. They just freeze.
That is a crucial insight for policy, isn't it?
Yeah.
If the government wants to boost investment during tough times, a broad brush, one-size-fits-all approach might not work. You need to specifically target that vulnerable middle layer.
Precisely. It changes how you should design your PLI schemes or your credit guarantees. You have to support the layer that freezes up first, otherwise your whole industrial supply chain can seize up.
Okay, so that's the scary, fragmented, AI-driven, tariff-shocked world outside our borders. A pretty bleak picture.
It is.
Now let's fly back to Mumbai, to the RBI headquarters on Mint Street. Section 2, monetary developments in India.
And the mood changes completely. It's like stepping into a different climate.
It really does. It feels controlled. It feels proactive.
Yeah.
The RBI seems to be playing a very different and a much calmer game. Let's look at the hard numbers from Section 3.N of the survey.
The pivot of 2025.
The repo rate was cut by a total of 100 basis points between April and December 2025. It now stands at 5.25%. And crucially, the MPC stance changed from accommodative to neutral.
Yes.
Help me out here. If they're cutting rates, which is clearly a move to stimulate growth and make borrowing cheaper. Why call the stance neutral? Why not stick with accommodative, which sounds more encouraging?
This is where the RBI's communication strategy gets very, very clever. The word accommodative implies a commitment. It's a promise. It implies we are on a rate-cutting path and we are going to keep conditions loose no matter what.
Okay, it sets expectations.
Yes. But in a world as uncertain as the one we just described, making promises is risky. Neutral gives the Monetary Policy Committee flexibility. It gives them optionality.
So it's like saying,
look, we've cut rates because inflation is currently under control and growth needs a bit of a push. But we aren't promising more cuts. It allows them to react to data on both sides. If global inflation spikes because of those trade wars, they can hike rates without losing credibility. If domestic growth slows, they still have the room to cut further. It's a position of flexibility, not weakness.
that makes sense. But the real headline, the move that had the bond markets buzzing, was the CRR cut, the cash reserve ratio.
That was a massive move, a real surprise.
It was a cut by 100 basis points, down to 3.0%. Now, for anyone listening who's a bit new to this, the CRR is the portion of deposits that banks must keep parked with the RBI, and they earn zero interest on it. It's essentially dead money from the bank's perspective.
Completely unproductive money.
So by cutting it from 4% to 3%, the RBI basically unlocked the handcuffs on a huge amount of cash.
They released what we call durable liquidity into the system. This is the key difference. A repo rate cut affects the cost of overnight borrowing for banks. It's temporary. But a CRR cut is permanent.
How much money are we talking about?
The survey estimates it was about 2.5 lakh crore. That's 2.5 trillion given back to the banks, not as a loan, but to keep and to do business with. It was a huge injection of permanent capital.
And that leads directly to a statistic that I think confuses a lot of students and is a potential trap in the prelims exam. Section 3.12 talks about money supply. Reserve money, or M0 growth, looked really low, only 2.9%.
Right.
If you just read that headline, you'd think the RDI is actually tightening the screws and sucking money out.
And you would be completely 180 degrees wrong. This is a classic prelims trap waiting to happen.
So walk us through why that number is so misleading.
Okay. Reserve money, M0, is the base money created by the RBI. One of its main components is bankers' deposits with the RBI.
Which is basically the CRR money.
Exactly. So since the RBI cut the CRR requirement, banks were legally required to keep less money with the RBI. So naturally, that component of the M0 calculation drops. It's a purely mechanical effect.
So the math makes M0 look small, even though the reality is the opposite.
Precisely. The actual money available in the banking system for lending increased dramatically. To fix this distortion, the survey uses a metric called CRR-adjusted M0. It's a way of looking at the underlying trend. And if you look at that number, growth was a very strong 9.4%.
So policy is actually expansionary. Very expansionary.
Highly expansionary. And the proof, the real aha moment that confirms this, is in the money multiplier,
which rose to 6.21.
That is a very, very healthy number. The money multiplier basically measures the efficiency of the banking system. It asks a simple question. For every 1 rupee of base money the RBI creates, how many rupees of broad money, that's M3, the money we all use, does the banking system generate through the process of lending?
It's like the gear ratio of the financial engine.
What a great analogy, yes.
Yeah.
A multiplier of 6.21 means the engine is running smoothly. It means the banks are not sitting on that extra 2.5 lakh crore of cash. They are lending it out. That loan becomes a deposit in another bank, which then lends out a portion of that, and so on. The friction in the system is low.
But there is always that lingering question, transmission. The RBI can cut rates, the banks can have high multipliers, but does the common person trying to get a home loan or a car loan actually see the benefit? Or do the banks just pocket the difference and increase their profits?
It's the most important question of all, isn't it? And the survey gives us a pretty clear answer here in section 3.16. The benefits are flowing through to the borrower. The weighted average lending rate, or WAL-R, on fresh rupee loans dropped by 64 basis points during that period.
Okay, so let's put that in context. The repo rate was cut by 100 basis points, and the lending rate on new loans dropped by 64 basis points.
That is excellent transmission. You have to remember, banks have other costs. Their deposit costs, their operating costs. They can't pass on every single basis point of a repo cut immediately. A 64 BPS drop tells us that the market is competitive. Banks are fighting each other for good borrowers, so they are forced to lower their rates to attract business.
Which brings us to the health of the banks themselves. Let's move to Section 3, the banking sector. And this is usually the part of the economic survey deep dive where we talk about NPAs and bad loans and get a bit depressed. But not this year.
Not this year at all. We are looking at a system that has been scrubbed clean. It's a remarkable turnaround story.
The headline number is just stunning. Gross non-performing assets, or GNPAs, are at a multi-decadal low of 2.2%.
2.2% is incredibly low.
Yeah.
I want the listeners to really contextualize this. Go back 5 or 6 years, and we were talking about GNPA ratios in double digits. We were in the middle of the twin balance sheet crisis, where corporate balance sheets were broken, and so bank balance sheets were broken.
It felt like a systemic crisis was just around the corner.
It did. But now both balance sheets are healthy. And what's more important is that it's not just the legacy bad loans from that era being cleared. The survey points to the slippage ratio.
What's that?
The slippage ratio measures the rate at which new bad loans are being formed. And that ratio is stable at a very low 0.7%.
That suggests that banks are actually lending smarter now, right? It's not just that they're cleaning up the past. They seem to be preventing future messes from happening.
Exactly. The underwriting standards have improved dramatically. There's better use of data, better risk assessment. They aren't just throwing money at anyone who asks for it anymore.
And regarding that cleanup of the past, the survey discusses the recovery mechanisms, the IBC and the Sarfisi Act.
Yes, the data shows they're becoming more efficient. The Insolvency and Bankruptcy Code, the IBC, its recovery rate has improved to 36.6% of the admitted claims, and Sarfisi is at 31.5%.
Now, I want to pause here for a second because there is a distinction that students, and frankly even the media, often confuse. We hear about loan write-offs and we hear about recovery. Can we just clarify that? Because the political narrative is often the government made banks write off loans for the rich, and it sounds like the debt was forgiven.
It's a vital distinction to understand. A write-off is purely an accounting entry for the bank. As per RBI guidelines, if a loan is bad for a certain period, the bank must remove it from its active asset list and provision for the loss. It's about cleaning the books so the balance sheet reflects reality.
But, and this is the key part, the borrower still owes the money.
Right.
The debt doesn't vanish into thin air.
Not at all. The legal obligation to repay remains 100%. The bank continues to chase the borrower for the money. Recovery is the process of actually getting that cash back, either through the IBC by selling the company or through Sarfisi by seizing and selling collateral. The improvement in recovery rates means banks are actually getting more hard cash back into the vault, not just using accounting tricks.
Got it. Okay, that's clear. So the banks are healthy, they're flush with cash, and they are recovering their old bad debts. So the big question is, who are they lending all this money to? Section 4, credit growth.
This is where the plot thickens. When you dig into the sectoral data, you see a huge disparity. The growth isn't uniform at all.
A huge disparity is right. Personal loans are growing fast, at a healthy 12.8%. But then you see this one-line item that just jumps off the page. Gold loans. They surged by 125.3%.
125.3% is an astronomical number for a single year. It's an outlier that demands an explanation.
So what is driving that? Is everyone in India suddenly running to the pawnbroker with their family jewelry?
It's likely a combination of two powerful factors. One is a valuation effect, linked to the price of gold itself. We saw in the global section that gold prices skyrocketed due to uncertainty.
Ah, okay.
So if your gold necklace was worth 1 lakh last year, it might be worth 2 lakh this year. That means you can borrow double the amount against the exact same piece of jewelry. So the value of the loan book can go up dramatically even if the number of borrowers stays the same.
That makes sense. It's a price effect.
But we cannot and should not rule out the second factor, potential distress borrowing. Gold loans are the quickest, most frictionless way to get cash in an emergency. You walk into a branch with gold, you walk out with cash in 30 minutes. No credit score check, no long forms. A surge this big often signals that some households at the lower end of the income spectrum are facing liquidity stress and need cash fast. It's a data point we need to watch very, very carefully.
On the flip side, a very positive story seems to be emerging in MSME credit loans to micro, small, and medium enterprises. That's booming at 21.8% growth.
Very positive. And the survey explicitly credits the new credit assessment model, or CAM, for this. We'll talk more about that in the tech section. But essentially, technology has made it much easier and less risky for banks to lend to small businesses that were previously considered unbankable.
However, when you look at the big players' industry and services, the growth is described as moderate, just single digits. So is Indian industry stagnating? Are big factories not expanding?
No, and the survey is very careful to correct this potential misconception. Industry is expanding and investing, but they aren't going to the banks for the money anymore. Large established industries are shifting to what we call non-bank sources of finance.
You mean they're raising money from the stock market and using their own profits?
Exactly. They are issuing corporate bonds, they are raising equity through QIPs, or they are just using their own massive profits, what we call internal accruals, to fund their expansion. This is actually a sign of a maturing and sophisticated financial system.
How so?
It de-risks the banking sector. You don't want the banks, which hold the public savings, to have all their risk concentrated in a few massive industrial projects. It's much better for that risk to be spread out among thousands of investors in the bond and equity markets.
So the new paradigm is
Mm.
banks for the small guys and the capital markets for the big guys.
Yeah.
That seems to be the trend.
That's a perfect way to summarize the shift.
Let's talk more about those small guys, specifically in the rural areas. Section 5 focuses on rural finance and the tech shift. And the regional rural banks, the RRBs, I mean, they are having a glow up.
Glow up is exactly the right word. Historically, RRBs were the weak link in the chain. They were often loss-making, inefficient, and poorly managed. But the survey reports that they've hit their highest ever CRAR, that's the capital to risk-weighted assets ratio of 14.4%, and their consolidated profits are way up.
How did they manage to turn the ship around so dramatically?
Government recapitalization helped, of course, but the real sustainable driver is technology adoption. They've finally modernized. They've adopted core banking solutions. They are meeting their priority sector lending targets, which is over 75% of their lending, not by handing out bad loans, but by using better data to find good borrowers.
And this brings us back to that CAM model, the credit assessment model, which the survey details in box 3.2. It calls it using digital footprints. How does this actually work in practice for, say, a small Kiwana store owner?
It's a complete game changer. Imagine that Kirana store owner. In the old days, to get a loan, he had to bring a pile of dusty paper ledgers to a bank officer. The officer would have to try and make sense of it, and a lot of it came down to the officer's personal judgment. It was slow, it was biased, and it was intimidating for the borrower.
Right.
The CAM model changes the game. With the borrower's consent, it pulls data directly from digital sources. Their GST filings, their income tax returns, their UPI transaction history, and their bank statements. An algorithm then analyzes this real-time cash flow.
So the algorithm decides, not a human being.
The algorithm assesses the ability to repay based on actual verified business income, not just on whether they own a house to pledge as collateral. The survey notes that 3.2 lakh crore worth of loan applications were processed in just a few months using this system. It reduces the fear of judgment for the borrower, and it massively reduces the operational cost for the lender. It's making credit friction-free.
That sounds revolutionary for the MSME sector. But it's not all smooth sailing in rural finance, is it? Section 6 addresses microfinance and financial inclusion, and it flags a pretty critical issue, the microfinance stress of 2025.
Yes. For a while there, it looked like we were seeing a bubble forming in rural lending, particularly in certain states.
The survey uses the term over-indebtedness, what was happening on the ground.
What was happening was a practice called evergreening of loans. A borrower would take a loan from MFI-A to pay off an existing loan from MFI-B. Then next month, they'd take a loan from MFI-C to pay off MFI-A. On paper, it looked like repayment rates were high, close to 99%. But in reality, the total debt pile per person was growing to unsustainable levels.
That sounds like a ticking time bomb. So how did the RBI intervene to stop it?
They used a very clever qualitative intervention. They didn't just ban lending or impose harsh quantitative limits from Mumbai. Instead, they instructed the microfinance institutions directly to stop the practice of evergreening. And, crucially, they empowered the self-regulatory organizations, the SROs, to enforce discipline from within the industry. The SROs imposed loan limits, saying you cannot lend to a borrower if they already have X amount of debt from other MFIs.
So they use the industry to regulate itself.
Exactly. And the result is that asset quality is now stabilizing. It was a close call, but it shows that the regulator was watching the ground-level data very closely and acted with a scalpel, not a sledgehammer.
Moving to the broader architecture of financial inclusion. For years, we've heard about the JAM, Trinity Jandan, Aadhaar, Mobile. Now the survey is talking about the next evolution, DPI, or Digital Public Infrastructure. And specifically, it highlights the Account Aggregator, or AA, framework.
The account aggregator is arguably the next big revolution after UPI. If UPI was about moving money, AA is about moving data with the user's consent, of course.
Can you give us a simple example of how it works?
Sure, let's go back to that Kirana store owner. He doesn't have a house to pledge as collateral for a loan, but he has a bank account that shows he receives €5,000 in UPI payments every single day from his customers. The account aggregator framework allows him to securely share a view of his bank account data, just the cash flow information, with a potential lender.
Without giving them his password or anything.
Exactly. The lender sees the verified real-time cash flow and says, okay, this person has a stable income. I can lend to them based on this income stream. It completely democratizes credit. It turns a person's own financial data into a form of collateral.
That is incredibly powerful. And the base of this entire pyramid, the Pradhan, Mantri, Yojana, now has 55.6 crore accounts. But the stat that really stuck out to me was the average balance. It's over 4,500 now.
That's the number that proves the success of the scheme. For years, critics used to say these were all zero balance accounts, that they were opened due to pressure and then left empty. But an average balance of 4,501 proves that people are using these accounts. They're saving, they're receiving DBT payments. That is real, genuine financial deepening.
Okay, let's shift gears to Section 7, the Insolvency and Bankruptcy Code, or IBC. We mentioned the improving recovery rates earlier, but there's a bigger picture here. The survey notes that international rating agencies have upgraded India's insolvency framework to Group B.
That's a real badge of honor in the global financial community. It's a signal that our laws for dealing with bankruptcy are now up to global standards. It gives foreign investors a lot more confidence.
But the expert in you is going to point out the flaws, right? It's not perfect.
Of course not. And the survey is refreshingly honest about the cons. The biggest one is still delays. The average time to resolve a bankruptcy case is still far too high, much longer than the law intended. The NCLT, the National Company Law Tribunal benches, are simply clogged with cases.
So what's the solution? More judges, more courts.
That's part of it, but the survey suggests a smarter solution: mediation. It proposes introducing mediation as a mandatory pre-insolvency step. Before you drag the company and its creditors to court, force them to sit across a table with a neutral mediator and try to work out a deal.
Like an out-of-court settlement.
Exactly. If you can settle, say, 50% of the simpler cases outside the formal court process, the NCLT can then move much faster on the complex, contentious ones that really need a judge's ruling. It's about decluttering the system.
That makes a lot of sense. Now, let's move to where the real excitement is in the markets. Section 8, capital markets. The retail boom.
This is truly the financial story of the decade in India.
The numbers are staggering. 21.6 crore Demat accounts. The survey says this translates to about 12 crore unique investors. That's roughly 1 in every 12 Indians now investing directly or indirectly in the stock market.
It's a massive structural shift in household savings. Box 3.7 in the survey details this beautifully. For generations, Indians put their savings in physical gold or low-interest bank deposits. Now, a whole new generation is moving that money into financial assets. It's a sign of an aspirational, risk-taking middle class.
But there's a really interesting detail in the IPO market that we need to highlight, the offer for sale, or OFS, component. The survey notes that a whopping 58% of all the money raised in IPOs last year was through OFS. Why does that specific detail matter?
Listeners, pay very close attention to this. It's crucial for anyone investing in IPOs. When a company has an initial public offering, the money it raises can go into one of two buckets. The first is a fresh issue. That means the money goes directly into the company's bank account to be used for building new factories, hiring people, or research and development. It's growth capital.
Okay.
The second bucket is the offer for sale. This is when the money goes to the existing shareholders, the founders, the private equity investors who got in early, who are selling their personal shares to you, the public.
So just to be clear, 58% of the money raised in IPOs didn't go to expanding the companies. It went into the pockets of early investors who are cashing out.
Precisely. It's exit money, not necessarily growth capital. Now, it's not inherently a bad thing. Early investors need an exit so they can recycle that capital into new startups. But as a retail investor, you absolutely must know where your money is going. Are you funding the company's future, or are you funding the founder's new beach house?
That's a very important distinction. And speaking of retail investors, let's talk about the F&O problem, futures and options.
The gambling concern, as SEBI has put it.
The numbers from the SEBI study quoted in the survey are just brutal. 93% of individual traders in the derivative segment lose money. 93%.
It is a wealth destruction machine for the average person who doesn't understand the risks.
Yeah.
They're drawn in by the promise of quick profits, but the vast majority just end up losing their savings. The survey details SEBI's crackdown. They've increased the contract sizes to make it more expensive to trade, and they're limiting those weekly expiries that encourage overtrading.
The goal is to gently nudge them away from speculation and back towards long-term investing, like SIPs and mutual funds, right?
Exactly. Push them back to mutual funds where professional fund managers handle the complex risk management. The market should be a venue for wealth creation over the long term, not a casino for daily bets.
Now, Section 9, debt markets. The host's favorite topic, the spare tire of the economy.
Yes, the corporate bond market.
For anyone new, why do we call it a spare tire?
Because if the main tire of the economy, the banking system, gets a puncture, like it did during the NPA crisis, the economy needs another wheel to keep moving. The corporate bond market is that spare wheel. Companies can raise money directly from investors instead of relying only on banks.
But the survey says our spare tire still needs a lot more air. It's underdeveloped.
It is. Right now, if you are a top-tier AAA-rated company, the safest of the safe, you can issue bonds very easily. There's a lot of demand. But if you're a good, solid, mid-sized firm with a BBB rating, good luck. There are almost no takers for your bonds. The market is very risk-averse.
So the key reform suggested in the survey is to develop a market that moves beyond just AAA-rated paper.
Yes. We need a proper high-yield bond market, a market for lower-rated bonds where investors are compensated for taking on higher risk with higher interest rates. Without that market, all those mid-sized firms we talked about earlier are stuck relying only on banks for their funding needs.
And within this market, there's a fascinating tug-of-war happening. FPIs versus DIIs. Foreign portfolio investors versus domestic institutional investors.
This is the Atmanirbhar market moment. It's a huge story. In 2025, FPIs were net sellers of Indian equities. They pulled money out, largely because interest rates in the U.S. were high and they wanted to move their money to safer assets. In the past, a big outflow of FPI money would have crashed our market.
But it didn't crash this time. Not even close.
Not at all. Because the DIIs are own domestic investors, which means mutual funds and insurance companies fueled by our own savings stepped in and bought everything the FPIs were selling. And the survey highlights a historic crossover point. The ownership share of DIIs in NSE-listed companies is now 18.3%, which is higher than the FPI share of 16.7% for the first time ever.
That is a genuinely historic moment. So our own domestic savings are now acting as a powerful cushion, protecting our market from global volatility. That's a huge factor for stability.
It is. It means our financial destiny is a little more in our own hands now. We are less hostage to the whims of foreign fund managers.
Let's move to the last major section, Section 10, pensions and insurance, the long-term savings story.
We see steady, strong growth here. The National Pension System, the NPS, grew by 30% year on year. And the survey also touches on the debate around the unified pension scheme. The proposal for a new scheme with an assured pension may be 50% of the last round pay.
The old versus new pension scheme debate.
Exactly. It's a massive challenge trying to balance fiscal prudence. We don't want to go broke paying pensions in the future with providing genuine Social Security for retirees. The survey just lays out the challenges.
And on the insurance side, there was some good news for the common person's wallet. GST relief.
Yes. A very welcome move. The GST exemption on term life and health insurance premiums, which came into effect from September 2025. This should lower the cost of essential insurance products and encourage more people to buy them.
The survey states the government's goal is insurance for all by 2047. How close are we to that?
Well, we are now the 10th largest insurance market in the world by premium volume, which is impressive. But our insurance penetration, which is the premium collected as a percentage of GDP, is still quite low compared to the global average. We have a massive protection gap.
Protection gap.
Yes. It means if a family's main earner dies unexpectedly, most families are still not financially covered by insurance to handle the loss of income. That's a huge social and economic vulnerability that we still need to fix.
Finally, we reach Section 11, the conclusion. And it brings us back to the title of the chapter. Refining the regulatory touch. After going through all this, what does that phrase actually mean?
I think it perfectly sums up the philosophy of this entire chapter. We have moved past the crisis phase of cleaning up the mess. That was the MPA crisis era. Now we're in the much more nuanced phase of managing stable growth. The touch required is different.
The survey mentions the FSAP report by the IMF and the World Bank, which seems to back this up.
Yes, the Financial Sector Assessment Program. It's like a health checkup for the country's financial system. And they gave India a very clean sheet, calling our system resilient to shocks. But the core regulatory philosophy that the survey highlights, based on the FSAP's recommendations, is proportional regulation.
What does proportional regulation mean in practice?
It means you don't use a hammer where a scalpel is needed. If a small fintech startup is taking a very small, contained risk, you regulate them lightly. You don't burden them with the same level of compliance as a massive bank like SBI. But if a massive bank is taking a systemic risk that could bring down the whole economy, you regulate them very, very heavily. You match the intensity of the regulation to the scale of the risk.
And the final piece of this refined touch is the consultative approach.
This is a big change in how the RBI operates. Now, before making any major new rule, the RBI releases draft regulations for public feedback. They listen to the industry, they listen to experts, they incorporate suggestions. It builds trust and leads to better, more practical regulations. It's not a dictatorship from the top, it's a dialogue.
So we've covered the globe, the rates, the banks, the markets, and the future regulatory philosophy. Taking a step back, what does this all mean for the listener, for the average citizen?
It means you are living in a financial system that is, for the first time in a long time, robust, modernized, and increasingly self-reliant. But
There's always a but, isn't there?
there is. Here's where it gets really interesting and a little frightening. We have these robust systems. We have CRR cuts, we have the IBC, we have proportional regulation. But remember where we started this conversation?
AI algorithms,
Yeah.
global fragmentation.
Yes. So the final provocative thought I want to leave you, which is this. We have spent the last decade building a brilliant regulatory system based on human judgment, human board meetings, and human timelines for decision-making. Can this refined regulatory touch keep up with a world where financial crashes can happen in milliseconds, triggered by an AI hallucination on the other side of the planet?
That is a very heavy thought. Can our human regulators keep up with the speed of the algorithms?
That is the trillion-dollar question for the next decade. The touch might need to become digital, instant, and algorithmic itself. And what are the risks of that?
Wow. Okay, learner, let that sink in. As you study this chapter, think about that fundamental tension between human regulation and machine speed. It's a fantastic point for a mains answer. Before we sign off, a quick reminder on study linkage. Please do not just listen to this. Go to the notes we've provided. Link the IBC section to the PYQs on bankruptcy reform. Link the financial inclusion section to the essays on inclusive growth. You must use this material actively.
Connect the dots. That's how you build knowledge.
And finally, strictly adhering to our housekeeping rules. If you found genuine value in this deep dive, please, and I'm humbly asking, subscribe to the channel, and if you can, join our YouTube paid membership. It truly keeps the lights on and allows us to keep this content free for everyone else.
And a huge shout out to our Legend members. You guys are the best.
And don't forget the free notes on Telegram. The premium notes, extra PYQs, and those crucial model mains answers are on the Discord channel for Legend members. Go join there right now. Thank you so much for listening. Keep learning and keep curious.
And stay analytical. See you next time.